Good day, everybody. Welcome to the Deloitte Economic Update webcast. I'm Craig Alexander. I'm Deloitte Canada's Chief Economist and Executive Advisor, and I'm pleased to welcome you to today's hour-long webinar. The purpose of today's session is to give you an overview of the economic environment in which we're likely to be operating in, talk about some of the key risks. We'll outline our highlights of our forecast that has just been published, but we also want to leave plenty of time for your questions. So we'll really only be hitting the absolute highlights. So in terms of the program, I'm going to hit the highlights of the macroeconomic global and Canadian picture, and then I'm going to turn things over to my co-host, Alicia Macdonald, who is going to take you through some of the highlights of our provincial forecast. If you are joining today and you wish to see and hear the webinar in French, just go to the view options on your Zoom and scroll to the shared screens and select the French under shared screens, and you'll be able to see the slides in French, and you'll be able to hear the French interpretation. So a reminder, you can ask questions anytime. Just in the Q&A function at the bottom of your Zoom window. And please ask questions about anything in terms of the economic and financial environment or the outlook. So with that, let's just get into it. So very quickly, let's start off with the global picture, and if we turn to the next slide. So from a global backdrop point of view, the world economy is headed into a significant slowdown. We can already see that this is taking place in terms of the high frequency data. From a regional perspective, the slowdown is not even. We can see that, for example, the Chinese economy, which has been a very powerful engine of global economic growth in recent years, has really lost momentum this year and is tracking towards growth of only around 2.5%. Part of the reason for this is the very heavy-handed way that China has been dealing with its health risks. In particular, its zero COVID policy, which led to shutdowns of cities in response to renewed infections earlier this year, really depressed economic activity and added to global supply chain problems. But the other story that's been playing out in China, which periodically appears in the financial press, is the deep problems in China's real estate markets. And real estate is about 20% of the Chinese economy. Due to overbuilding, due to the accumulation of a lot of bad debt in the real estate sector, the real estate sector is really acting as a very strong headwind on China's economic growth. As we look forward, we can see that economic conditions in Europe are deteriorating. This is because Europe is not only affected by the very high inflation rates that we are getting, but are also affected by the European Central Bank raising interest rates, and it is directly impacted by the economic disruptions coming from the war in Ukraine and the sanctions on Russia. We can see, when I talk to my Deloitte Chief Economist counterparts in Germany, in Italy, in the UK, they are all expecting to see economic contractions late this year and into early next year. So I think that the outlook for Europe is very clearly, the consensus is that we are going to see recessions in the Eurozone and in the UK. When we look at North America, the US story is much more nuanced, and that is because in the first half of this year, we saw contractions in the first half of the year in the first and second quarters. But while that led to people talking about a technical recession in the United States, in fact, the US economy was healthier than it looked. It was still creating lots of jobs, and a lot of the other high frequency indicators were still showing the US economy with significant momentum. So that has not deterred the US Federal Reserve from raising interest rates in order to bring inflation down. And while I think economic growth resumed in the third quarter of this year, the outlook is that the US economy is going to feel the lagged effect of the very rapid increases in interest rates being delivered by the central bank. And I think that the big eye-opening event when the Fed delivered its last rate hike a little over like a week and a half ago was when it announced not the 75 basis point increase that was priced into markets, but rather where it expected the Fed funds rate to be at the end of this year. And they signaled it would be around 4.5% by the end of this year, maybe getting up to 4.75% next year. That's more than markets were expecting, and it's why we saw a very big pullback in equity markets, because it raises the risks of a hard landing in the US. And obviously, a weaker US economy would create additional weakness for Canada because of Canada's deep trade ties with America. Let's go to the next slide. When we turn to the Canadian economy, what we can see is Canada has had a very strong rebound after the lockdowns occurred. Economic growth then moderated, but was quite solid in terms of quarterly growth. And inflation reached a 40-year high. Now, one of the things I would stress is that a lot of the inflation we've been getting has come through global supply chains and because of disruption in global supply chains and from higher commodity prices. But we can see signs that progress is being made on those fronts, and inflation did indeed peak. I feel inflation peaked, and it has now come down in terms of the consumer price index to 7% in terms of the most recent monthly numbers. And we think it's going to trend lower in the coming days, partly because the supply pressures will abate, but also because of the Bank of Canada's rate hikes. Let's go to the next slide. We think the bank, the aggressive increases in the overnight rate by the Bank of Canada has been, in terms of the speed, it has been remarkable. And they have signaled that they are likely to raise rates again in October. And we've put another half-point increase in the overnight rate into our forecast, lifting the overnight rate to 3.75%. The question is where they go from there. And certainly, if the U.S. Federal Reserve keeps pushing up interest rates, this runs the risk that the Bank of Canada will raise rates further. But in my opinion, the Bank of Canada has already done a lot to take some of the price pressures out of the demand side of the Canadian economy. And so, I hope that the Bank of Canada doesn't continue to tighten policy beyond October. So we've put the Bank of Canada on hold after October, but this does create a downside risk to our forecast if they do continue to lift interest rates. Let's go to the next slide. What the increases in interest rates are doing already is they are starting to weigh on the Canadian economy. And we can see that in terms of the correction that's taking place in Canadian real estate, and I still think that there's a ways to go in terms of the pullback in real estate activity in Canada. It takes time for higher interest rates to have their full impact, and the weakness in Canadian real estate will play through to weaker consumer spending, and it is starting to show up because you can see it in terms of weaker purchases of appliances, of furniture, weaker renovation activity. And so on the consumer front, what we're likely to see is that housing related purchases and interest rate sensitive purchases like automobile purchases are likely to soften in the coming months. Where I think we're probably going to still see good consumer spending is where there's a lot of pent up demand, like on services. So, restaurants and some of the hospitality sector, what we've seen is that Canadians, Canadians couldn't, spend a lot of money in areas that they wanted to during the pandemic. And so even though prices are way up for these sort of services, they're still willing to pay because they've gone without. So the story on consumer spending is the consumers are still likely to continue to spend, but aggregate consumer spending is going to be more moderate, and on interest rate sensitive areas, it's going to be quite weak. Let's go to the next slide. There are concerns about the enormous amount of household debt that Canadians have. But one of the things I would stress is that rather than looking at the debt to income ratio, which is actually a terrible metric that compares the stock of debt to the annual flow of income, the right way to look at this is the total of cost of servicing your debt relative to your income. So it's your debt service costs that matter. And the starting point is quite low. As we move forward, what's going to happen is debt service costs are going to rise because interest rates have increased, but it's going to take time for it to be felt. So for Canadians that have adjustable rate mortgages, they're going to feel it immediately. But for many other Canadians, they're really going to feel it when their mortgage is renewed. So it will take time for the full impact of the higher interest rates to be felt. And I don't expect we're going to see anything like a US phenomenon where, we had in 2008 with, I don't think Canadians will lose their houses. I don't think you're going to see a big increase in consumer insolvencies or bankruptcies. I think it's going to be like inflation. I think the higher interest debt service interest burden is going to basically leave Canadians with less money for other spending. Let's go to the next slide. But there is a couple of important offsets here. And the first one is Canadians saved a lot during the pandemic, not because they became frugal, but because they couldn't spend on things they wanted to spend money on. And so typically in an average year, Canadians save on average between 25 and $35 billion a year. Well, in 2020 and 2021, they saved $360 billion. Now, some of that buffer has been eaten up by high inflation, but there still is savings out there that's acting as a buffer, and it helps explain why consumers have kept spending when inflation has been outpacing their wage growth. And similarly, I think that as the interest rate impact is felt, the savings buffer is going to continue to be drawn upon. Now, I don't think it's equal. I don't think low-income households in Canada have much in the way or any savings to fall back on. I think a lot of this savings is really acting as a buffer for higher-income households. Let's go to the next slide. What I think is more important for the general economy and for all Canadian households is the fact that Canada is experiencing very tight labor markets at the moment. And when I talk to businesses from coast to coast, the number one issue they're dealing with right now is labor shortages. And when I talk to businesses about the possibility of a looming recession, one of the things I constantly hear is that businesses are reluctant to lay off workers if they think the coming weakness is going to be temporary. If they think the weakness is going to be 2 quarters, 3 quarters long, they're unlikely to reduce their payrolls significantly because it's going to be so difficult to rehire. And so if businesses act the way they are currently communicating, it means that if we have a period of economic weakness in response to the higher interest rates in Canada and abroad, we may not see the impact in unemployment that we've seen during past cycles. And this would provide a lot of support to the economy and to workers. Let's go to the next slide. The other factor that I think could really play into the outlook for Canada in terms of growth, or the profile for Canadian economic growth, is what happened in inventories. In the second quarter of this year, $46 billion of inventories were accumulated in the second quarter, and that is unheard of. In history, we've never accumulated that much inventory in a single quarter. And talking to businesses, some of it was because of weaker foreign demand, but a lot of it seems to have been because of a normalization in supply chains. A lot of orders that had previously been made suddenly were filled. And this actually creates a headwind for the economy, because when businesses have accumulated a lot of inventories, they tend to work them down before they start producing more or before they start ordering more. And that will actually act as a drag on economic growth. Although I would stress that the improvement in supply chains, it makes me more optimistic that we're going to see inflation come down in the coming months. Let's go to the next slide. So, and when we do the global backdrop, I think one of the big stories is going to be the fact that the slowdown in the world economy is going to impact Canadian trade, and so we're not going to see the growth in Canadian exports that we might have hoped for. Let's go to the next slide. So when we put the elements together, I think that what we have is a story where consumer spending is going to moderate in response to the higher interest rates and the continuing elevated level of inflation as it gradually comes down. I think residential investment is going to be very weak, and we're going to see a contraction in the real estate market. I think we're going to see net trade being a drag on growth, and when you put that together, I think it paints a picture where we probably are going to see a couple of quarters of contraction in the near term, which will likely meet the definition of a recession. But one of the things I would emphasize is that some of that weakness is going to be coming from the swing in inventories. And as long as the labor market remains relatively tight, if what we see is unemployment coming up, and we have it coming up to around 6%, that increase in the unemployment rate is still an environment where the labor market in Canada is quite healthy. So I think from a business point of view, the issue around labor scarcity is still going to be with us. And if Canadians still have jobs, the prospects are that the period of weakness we're going to have is going to be relatively limited. I think the downside risk, the scenario where the recession becomes more severe, is one where the central banks continue to raise interest rates beyond October and significantly in order to fight inflation. The more they take interest rates, beyond 4%, the greater the risks that the mild recession turns into a severe recession. So with that, I'm going to turn things over to Alicia to provide you with some highlights from the provincial forecast.
Thanks, Craig. I'm going to just very briefly go over the provincial forecast now and how the factors that you talked about are expected to play out at a provincial level. So if we could advance to the first provincial slide, please. Thank you. So the impact that we are seeing right now on the economy from those higher interest rates and the elevated level of inflation is on the housing market. However, when we look at what's happening across the provinces in terms of how housing volumes are faring, there are some pretty noticeable differences across the country. We're seeing, we could just go back. Yeah, we're seeing in Ontario and BC some very sharp declines in resale market activity, which are acting as a headwind to growth in those two provinces. Home prices are very high in those two markets, and higher interest rates mean that fewer people are able to qualify for mortgages in those provinces. Of course, this phenom is affecting housing markets right across the country, but the high price point for homes in those markets is really amplifying the impact. On the other hand, we are seeing housing markets hold up better for now in Alberta, Newfoundland, and Saskatchewan. And this strength here reflects two main factors. Prices for energy have been very high year to date, and that has resulted in a lot of money flowing into these economies, which in turn generates demand and is helping bolster their economic performance relative to what we're seeing in other provinces. The second reason is also tied to energy markets, but looking a little bit further back. These three provinces all experienced deeper recessions back in 2020 as they suffered the double whammy of the oil price collapse as well as the pandemic. And so when we look at these three provinces, they're still in the recovery phase of their economic cycle. And so they've got a bit of extra demand that is still flowing into their economies. Now, as Craig talked about earlier, not only does the housing market have that direct impact on the economy, but it also creates several trickle-down impacts. The deeper the housing market correction, the more impact that we're going to see on household spending on those type of interest rate sensitive purchases, such as furniture, appliances, etc. They also do have a big impact on debt servicing costs. When we look at BC and Ontario, they have the highest debt levels across the country, tied directly to the high average price of real estate. And so as interest rates rise, they're going to see a more negative impact on their debt servicing costs, given those higher debt levels. Debt levels are lower on the East Coast and in Quebec, where affordable housing has kept debt burdens more manageable. But again, this doesn't mean that we won't see an impact of rising interest rates in these markets. It's just not going to be as severe as we're seeing in markets like Ontario and in BC, given that households in those provinces are in a bit of a better financial circumstance heading into this slowdown. If we could move to the next slide. So typically, the worst recessions are associated with large job losses that reinforce that cycle of reduced demand. However, when we look across the provinces, those tight labor market conditions that Craig touched on a few minutes ago, they're evident right across the country. This chart here shows the job vacancy rates across provinces. And while unsurprisingly, there are regional differences, you can see that every single province has tighter labor markets right now than they did a year ago. And these tight labor markets are really going to help to have that buffering impact on this downturn. As employers, they're telling us in conversations that they're reluctant to let their workers go. And so because we're seeing these tight labor market conditions right across the country, we think that all provinces will have a little bit of that offsetting support to the coming slowdown, because labor markets are expected to fare relatively well, despite the expectation that unemployment rates are going to touch up across the country. If we could go to the last slide. So when we consider all the factors that are affecting demand in each of the provinces, we do expect to see most provinces experience a pretty significant slowdown or outright contraction in economic growth next year. Now, BC and Ontario are forecasted to see the largest decline in output, given those impacts that we discussed earlier. Quebec is also expected to see a small decrease in its real GDP growth, given reduced demand in its important trading partners, but its relatively low debt burdens and its very tight labor markets will help keep it from experiencing a more significant downturn like we're seeing in some of its neighboring provinces. The standouts for next year will be the large energy and agricultural producers in the prairies. They're really riding a tailwind as we head into the slowdown associated with high prices, rising demand, and also a rebound from some drought conditions last year that really depressed agricultural production. On the East Coast, Newfoundland and Labrador will experience some pretty solid growth next year as oil production ramps up and we see construction accelerate on the new Bay du Nord project, while the rest of Atlantic Canada faces a small drop in output next year as their housing markets retreat. Population growth starts to ease a bit. They did very well during the pandemic with net interprovincial migration, and they're more susceptible to trade with the EU than the rest of Canada. And the recession expectations for the EU and UK will weigh on their growth prospects there. And so that brings me to the end of the quick overview on the provincial outlook. I'd like to open the floor now to questions as they relate to our latest outlook. And Craig, we have the first one that came in earlier from Steve Joseph, and he's looking for some additional information on how the current energy crisis in Europe and elsewhere will affect the North American economy, specifically with regards to inflation, energy security, and food supply. Oh, you look like you're still on mute, Craig.
Had to happen, right?
Of course.
So the part of the expectations for a recession in Europe is tied to the energy crisis that's taking place in Europe. There's every expectation that we're going to continue to see very high energy prices through this winter, and that is going to make it much more expensive to heat homes. It's going to weaken their economies. It's going to contribute to the high inflation, which is causing interest rates to rise. And so, the energy crisis is a core part of the outlook for a very weak Europe. Here in North America, what's happening in Europe impacts us several different ways. First of all, there's our direct trading relationships with Europe. And it can be direct or indirect, right? So it can be, Canadian businesses that sell to U.S. businesses that then are selling into Europe. It can be Canadian businesses directly selling into Europe. And at the same time that there's weaker European demand for North American products, the strength of the Canadian dollar and the U.S. dollar against the against the euro and the pound sterling is also not only it's also making our products more expensive for Europeans, and so it's a bit of a double hit because it's weak demand and our exports being less competitive. So that adversely affects our economy. Then there's the extent to which the energy crisis in Europe is leading to higher energy prices here in North America. And this has been part of the story in oil prices, but also in natural gas. And if you went back in time, if you went back to the 90s, early 2000s, the natural gas market was very much a continental market. You could have big swings in natural gas prices in Europe that wouldn't have any impact here in North America because you didn't have the capacity to export to Europe. But because of the capacity now to do shipments of liquefied natural gas, which in the United States there's the capability of transforming natural gas into liquefied natural gas. It means now the natural gas prices North American prices are affected by what's happening in Europe, and it does push up North American prices. So it could mean that we do have higher than we're unlikely to have the natural gas prices that Europe has, but it does mean all else equal, we will have higher natural gas prices. The issue around food security is a big one. When the war in Ukraine broke out, and there was the concerns about the loss of agricultural supply from Ukraine, because Ukraine has long been viewed as the bread basket of that region. It meant that food security for the countries that traded with Ukraine for agriculture was going to be a major issue. Now, it actually creates some opportunities for Canada, for example, like in terms of selling fertilizer, because what's happened is other parts of the world are having to step up their increasing agricultural supply to offset the loss of Ukrainian supply. But here in North America, the big issue on food security is around inflation, right? The cost of food prices going up well, way faster than the incomes of the food prices going up way more than the incomes of low-income Canadian households. And one of the most discouraging things to see in the data is the increased food bank usage in Canada. And when you see people using food banks, you know that they're not doing it because they'd like to. It's because they have to. And so it is an issue. It is a concern. And this is where I differ with some of the economists out there that have been critical of the government doubling of the GST rebate, where there has been concerns about the federal government support for low-income households because it would add to inflationary pressures. I think in point of fact, we need to recognize that inflation is highly regressive and is going to impact low-income households very severely. And so I think that to the extent that I think that low-income households in Canada were going to need some additional support from governments during this period. And if it means the Bank of Canada has to hike an extra quarter point, and arguably that's the most they would have to do in response to the additional income support, then it's a low price to pay to provide some additional support to help address food security in Canada. Alicia, we have a question here that's related to Alberta housing prices. So the question is, do you believe that the relative affordability of Alberta relative to Ontario, combined with work from home, will sustain Alberta home prices?
Yeah, that's a great question. One of the things that we've seen over the past few quarters that's really helping to support economic growth in Alberta is a return to positive net interprovincial migration. We're seeing a lot of residents move to Ontario, from Ontario to Alberta, presumably because of the affordability factor. However, when we look at where housing prices have moved in Alberta already, we can see that they are down from their peak. So we do see some pullback in pricings despite that positive demographic push. As I noted earlier, Alberta's housing market is still holding up fairly well in terms of transaction volumes. Recent months have looked a bit weaker, suggesting that the same factors that are affecting the housing market on a national level are starting to trickle down into Alberta. When you look at debt levels in Alberta, they are third behind Ontario and BC. And so we do expect to see some housing market impact in Alberta because of higher interest rates. That being said, we don't see the correction in their housing market being as significant in Ontario and Alberta and BC. And part of that is the positive migration story, which will help support demand and housing prices in the province.
Great. Again, please, in the Q&A function in Zoom, please type in your questions. You can ask anything. We're happy to try and tackle any economic or financial question that you might have. So we have a question from Claire. What is the overall outlook for Canada in the next 5 years on a global stage? And that's a great question, because we've really focused on the near term and the risk that in the next 12 months we could see the Canadian economy experience a recession. But when we look farther out, we look over a 5-year horizon, we need to recognize that really what we're talking about is, yes, there could be a turn in the business cycle, but history is a great guide, right? Recessions are typically 2 to 3 quarters long. When a recession hits, what will happen is we'll see a reversal in policy. Interest rates will come down. You can get fiscal stimulus. I should stress that if we see a recession, inflationary pressures will dissipate very quickly. Businesses do not raise prices during economic contractions. In fact, they start discounting, and so in order to get products to move. And so inflation, central banks know how to fight how to make inflation go away. Once there's an economic contraction, it will disappear, and then that actually sets you up for the next cycle upwards, and you then get the recovery and the expansion. And I think on when we're looking out over a 5-year period, the outlook. If I was talking to, if I was thinking about from a business point of view, executive team putting together a business plan, what would I be expecting over the next 5 years? I'd be expecting to see moderate economic growth over those 5 years, but with some near-term downside risk. I would expect that, the pace of economic growth in Canada would probably be, the trend rate of growth in Canada is probably going to be just a little under 2%, because that's what the economy can support on the basis of the growing labor force, which is constrained by an aging population but supported by strong immigration, and Canada's productivity. I think that I think Canada faces some big medium-term challenges in order to get a even better performance over the next 5 years. I think that from a competitiveness point of view, I think Canada needs to think about how to become more competitive in terms of, we need to see more investment in productivity enhancing machinery and equipment. And this is one where I think that there's a silver lining from the labor shortages that we've recently been having, because many of the businesses I've been talking to have actually been thinking about, how they can economize on labor through investment in machinery and equipment. And, quite frankly, we're going to need that, because as the baby boomers exit the labor force, we're going to continue to see that immigration is responsible for, 100% of labor force growth, and aggregate labor force growth is going to remain limited. And so I think that the labor, like even after near-term weakness over the next 5 years, I think labor scarcity is going to continue to be a dominant theme. And so how do businesses respond to that? And I think that the way you have to respond is you need to find ways to make the most of the workers you have. And one thing that you need to do is remove the barriers to success to some workers, right? So we need to continue to break down barriers to success that face women, Indigenous people, people of color. In other words, groups that face barriers that prevent them from realizing their full potential. But we also, at the same time, we're going to need to invest in additional technology, and find ways to be more capital intensive as an economy. And to the extent that the tightness in the labor market induces Canadian businesses to finally do that sort of investment, I actually think the tightness in the labor market is constructive. So I think on a 5-year basis, I'm optimistic that we'll see moderate economic growth. But I think that Canada really needs to up its game if we're going to, outperform or perform well on the global stage. Because I actually think that, I think one of the challenges we have is that in recent years, Canada is increasingly been looking like it's a more difficult place to do business. Canada is a very easy place to start a business. We rank number 2 or 3 in the world in terms of the ease to start a business. But when it comes to growing and scaling businesses, Canada doesn't rank nearly as high. We rank somewhere like 16th in terms of growing a business. And when it comes to regulatory competitiveness, Canada actually ranks very poorly. So I think there's a lot that we need to do to really up our game in terms of being a more competitive country. And I think that's a conversation that we need to have as we move forward. And I think there's a role for government and business to play in terms of becoming, pushing Canada on a more competitive path. Let's see, other questions that were coming in. So Alicia, there's a question here about the impact of job losses in Ontario?
Yes, so as I mentioned, we do expect the
Oh,
downturn.
and sorry, and specifically in tech, startups, and consulting.
All right, consulting. So Ontario is expected to have a bit more of a severe downturn than what we're seeing in other provinces. As such, the labor market impacts are going to be a bit more notable than what we see at the Canadian level. While we see the unemployment rate in Canada peaking at 6% in the third quarter of next year, in Ontario, we do expect that to reach 6.7% at that same time. Now, as we've noted, labor markets are tight. We don't expect very broad job losses across the economy. And so where we expect job losses to be concentrated are more in those sectors that are feeling the brunt of the downturn. So this is real estate agents and brokers, a bit in the construction market as renovation activity slides, wholesale and retail trade as reduced demand for consumer durables hits those sectors. We've seen in recent months a bit of pullback in the public service employment in Ontario, education in particular last month. And so these are the specific sectors where we think we'll see some job losses over the coming quarters. When it comes to professional technology, consulting jobs, those have been one of the growth leaders, not only in Ontario, but across the country. There's been a significant wrap up in demand for these services. Labor markets are exceptionally tight, and so there's a real disincentive to lay off workers in those fields because they've proven so difficult to get in the door, and demand has been so strong that we think that's one of the areas of the labor market that's going to remain resilient over the coming year.
We've had a bunch of questions that are all related to the labor shortage and labor scarcity issue. The economic advisory team and I put together a sort of a deep dive on this topic because, you know, I've a very simple rule of thumb. If I have 3 clients ask me the same question, you know, I know that people want to understand the answer. And so we put together a note about, you know, where did the workers go? And you know, I've published the piece of research through my LinkedIn account. So anybody that's wanting a deep dive on, you know, understanding Canada's labor shortages, you know, just reach out to me via LinkedIn, and you'll be able to access the research. Really, what it showed is that in the United States there was the Great Resignation, where a lot of workers left the labor market. There was a huge drop in labor participation, and at the same time there was an increase in labor demand as the recovery took hold. And the labor shortage issue in the United States is actually far more acute than it is in Canada. In the Canadian context, it's interesting there's a bunch of things that took place. We did see a drop in labor supply, but it was workers age 55 plus, so older workers, probably workers that were more at risk from a health point of view, that we saw a drop in their labor participation. But for prime working age adults from age 25 to 54, we actually saw labor participation rates climb, and that's a story you never hear told. And it showed that, like, when there was jobs to be found, when, you know, there was a lot of labor demand, when employers were willing to offer flexible work and remote work, it attracted workers to actually participate in the labor market. And so labor supply in Canada really hasn't been the problem outside of the bigger issue that we have an aging population, and that is constraining aggregate labor supply growth. So it wasn't sort of pandemic. We didn't have a pandemic-driven labor supply problem, other than the loss of older workers who may have left because of the health risks. Then on the labor demand side, what's really interesting is the amount of shift that we saw across occupation and across industry. So when you look at it by occupation, there was a huge drop in the number of sales positions. Like we've lost something like 360,000 sales jobs, and that that's where you're finding retailers saying they can't find adequate staff. This is the hospitality sector saying they can't find wait staff, and but those workers have gone on to employment somewhere else. And what we've seen is the job creation has been very strong in full-time positions, in good paying jobs. And so there seems to have been a shift in terms of the labor market. And when we look at it by sector, we saw a lot of strong growth in employment in the health sector, in professional services, in consulting, in financial services. So what we've really had during the recent environment, I think, is really a combination of the labor shortages are sectors that have been growing that can't find enough workers to meet their needs because they're growing rapidly and they can't find the workers maybe with the skills or the experience they need. And at the same time, there's the hard-hit industries like retail or segments of retail, food, accommodation, and these sectors that were hard hit, suffered from the lockdowns, and then as they've been trying to recover, have found it very hard to staff. And so it's really been sort of a different narratives within the landscape. But the broader issue is, in aggregate, I think that the tightness in the labor market is simply going to persist. And one of the questions we have is around salary and wages, adding to inflation pressures. I would stress that we actually have wages are not the principal thing driving up inflation. In fact, wages have been lagging inflation. So the order of things here is inflation went up. That meant the cost of living went up. And then workers said, hey, if my cost of living is going up that much, I need a higher wage. So the expectation would be if inflation came down, the wage pressures would diminish because workers would recognize that the cost of living isn't going up at the 6-7% that we've been experiencing. The real challenge is going to be what happens as inflation comes down if wage growth remains elevated. Right now, wage growth is running at around 5% year over year. It's 6% in the private sector and 3% in the public sector. But the public sector is heavily unionized, and union contracts are only renewed when they come up for renewal. So there's a lag. And I guess one of the things that the Bank of Canada is worried about is, if wage growth stays at, say, 5%, and that is the number one cost that businesses have, well, then maybe inflation doesn't go back to 2%, which is the target. Maybe it goes back to 3.5%, and which case it's above the Bank of Canada's target. So if you want to understand what's happening to the risk in terms of where the Bank of Canada is taking interest rates and the risk of inflation, I think it is important to watch what happens to wage growth going forward. If wage growth diminishes as inflation comes down, then I think that the scenario that we've been playing out, or we've been painting, will play out. If wage growth doesn't slow, or worse, if it accelerates, then I think the Bank of Canada will feel that it has to raise rates by even more. And then that creates more downside risk. But I want to stress that wages have not been the principal driver of inflation. It hasn't been wage push inflation up to this point. It's really been demand and supply side pressures. And I think when I look at those factors, all of the elements are falling into place for inflation to head significantly lower in the coming months, particularly after we get past the 1 month anniversary or the 1 year anniversary of the war in Ukraine. Because remember, the way we measure inflation is the year over year change in prices. So when you get to, when we get to next March, the year over year comparison in energy prices is going to look more favorable because you're going to be past the 12-month anniversary of the energy shock that happened from the war in Ukraine. So, in a whole variety of cases, the year-over-year comparison is going to get much more favorable. And so you're going to see, I think we're going to see inflation come down quite sharply. It will take, in our forecast, it actually takes till 2024 to get back to 2%. But by the end of next year, we are back down to within the Bank of Canada's 1% to 3% band. So we're below the 3% mark by the end of next year. There's a question for Alicia. What is the biggest threat to Atlantic provinces as a result of the recent storm, or the economic threat from the storm?
Yeah, no, that's a very relevant question. When we look at the recovery efforts from Fiona, we know that there are still a number of households, thousands of households, in fact, without power even there. And so when you have that type of natural disaster hit an economy, the immediate impact is negative through that lost effect on output. People can't go to work, businesses can't operate, normal course of business tends to cease. But when we do look at that, it tends to be a few days of lost economic activity. And what we actually see from an economic perspective is that the additional funding required for the recovery efforts has a stimulative impact on economic demand. So you really see natural disasters hit the economy in very small microbursts. You have demand front-end loaded because people know the storm is coming. They go to Home Depot, et cetera. They get their supplies. And so some of their consumption that would have normally occurred during the storm and the days after is front-end loaded. But then you see funding typically come from governments, other households flood in to repair lost infrastructure. And that has, like I said, a stimulative impact. Where the bigger threats are on the destruction of capital. And if there's a decision to not rebuild, we saw particularly lots of fishing communities really hard hit. And so if there is a conscious decision not to rebuild those lost industries, then that's lost output that never comes back. And there's the associated employment impacts with that. So there are a number of factors that we're going to be watching unfold as the provinces in Atlantic Canada move more into a fulsome recovery, and particularly that loss of capital and what will be happening with the rebuilding effort.
Okay, we also have a question about the, how does our point of view impact investments in resource-based economies? And the outlook for slowing global growth implies weaker global demand for raw materials, and that will lead to lower commodity prices. But one of the things that's a bit unique about the current environment is the fact that we had the pandemic downturn, and we really didn't get much in the way of new investment during the period of during the recovery and the recovery and expansion since the initial lockdowns. And so we haven't had the sort of the typical overcapacity investment that is typical in a business cycle that normally then gets unwound during global periods of global weakness. And this isn't just in Canada, even internationally, we haven't seen businesses adding to the resource capacity the way they have in the past. And talking to commodity strategists on Bay Street about their forecasts of commodity prices, many are expecting commodity prices to remain well above where you would expect them to be during typical down cycles. Like, yes, the world economy is experiencing, a significant slowdown. Like, if world economic growth drops to around 2% next year, which is actually around the level that is typical for a global recession. So in a global recession, the world economy does not experience an outright contraction. In history, the only times we've seen the world economy contract was the Great Depression, during the financial crisis of 0809, we had a very small contraction, and during the pandemic, we had a contraction. But outside of those periods in history, the world economy has not contracted. So normal business cycles do not have a contraction. They have global growth dropping to around that sort of 2% mark. But on the resource side, what happens to prices are affected not just by what happens on demand, it's also affected by supply. And so if supply is tightened at the same time that demand weakens, you don't get as much of a price cycle. And the reason that's important is if you get less of a price cycle, it provides more resilience to your sort of commodity economies. And we can already see that, for example, on the energy side, OPEC is already cutting back supply, right? They're anticipating that they're already anticipating that there's the world economy is weakening, so they're taking actions to limit how much energy prices fall. And I think that we're seeing, when I talk to analysts that cover the base metal sector like copper, zinc, aluminum, etc., again, the supply story is not one where we have a big overhang. So this isn't to say commodity prices aren't cyclical. There probably will be a cycle in commodity prices as world demand moderates, but it might be less pronounced than we've seen in the past, and that's positive, or at least it provides some support to your resource economies. So we're in the last couple of minutes, so we should really sort of wrap things up. So the last question I'm going to cover is an important one, and it's, what one piece of advice would you give to business leaders going into a recession? And my number one piece of advice is that recessions aren't something to fear. Recessions are just a natural part of the economic cycle. Any business leader who has been around for a decade or two has experienced recessions. And they're always different. They always have different qualities. They always have a different flavor to them. But we also know that they are always temporary. Even the most severe ones that we've ever had have been quite temporary and have lasted by less than 4 quarters. So when you think about how long is the valley you have to manage through, I suspect that this is going to be more of a typical cycle. So I think that the valley is probably going to be more like 2 to 3 quarters long, and then you will see a reversal. One of the questions we didn't get to was, will interest rates decline? And the answer is yes, they will, but they probably won't go back down to what the lows that we've had, and that would be a good thing, because the low rates we had were actually creating their own problems, like overvalued real estate. I think that the Bank of Canada will cut rates when inflation comes down. I think that the government of Canada will try not to add to inflation in the near term, but if the economy weakens significantly, I could see targeted stimulus to support the economy as well. From a business leader point of view, I'm always interested in how businesses have historically responded to recessions. And the number one response by 70 to 80% of firms is to cut costs. And it's natural, it's the knee-jerk reaction that when profits decline, when revenues aren't as strong, to tighten your belt. But what I'm really fascinated by are the other responses. And the Bank of Canada did a survey of firms, and they asked, how did you respond to the 2008-2009 recession? And while the number one response was to cut costs, the other responses were to invest in new technology, to look for new markets, to invest in additional talent. In other words, taking advantage of the softening in the labor market to recruit talent, to look for strategic partnerships, to look at opportunities to diversify the business. All of these responses to a recession, I think, are very constructive and actually not only respond to the immediate weakness that a business is experiencing, but really positions businesses to thrive when the recovery comes and when the subsequent expansion phase comes to fruition. So I think that businesses do need to think about their balance sheets. They need to think about how they are positioned for the near-term weakness that we're going to see. But just like the question about the longer-term view, the 5-year horizon, you can't let the near-term risks paralyze you. And I think that thinking about the medium term is equally important, and thinking about where to invest and how to position yourself to thrive, through a period of weakness, but more importantly, into the recovery and expansion, is really how businesses position themselves for long-term growth. So with that, I want to thank you all for your time and attention and joining us for today. If you want ongoing updates and insights on the economy, again, follow me on LinkedIn. I put out commentary on the economic indicators as they come out, and with weekly commentary on developments. And it's also where we post some research. So, and I would encourage you to follow the quarterly outlook. So with that, again, thank you so much for your time and attention, and I hope today's webcast was useful and informative. Thanks very much, everybody.